Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Rolls-Royce's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Rolls-Royce Holdings is a British aerospace and defense company that designs, manufactures, and distributes power systems for aviation and other industries. Its civil service division is a major manufacturer of engines for large commercial aircraft and regional jets. Its Power Systems division is a leading provider of high-speed engines, propulsion, and power generation systems for the marine, defense, and industrial markets. Its Defense division is a market leader in engines for military transport and patrol aircraft, with strong positions in combat and helicopter applications. It also supports the nuclear power plant for the Royal Navy submarine fleet. It also provides maintenance, repair, and overhaul services for regional airlines, business aviation, industrial, and defense applications. Their ITP Aero division develops, manufactures, assembles, and tests engine components. In September of 2021, they signed an agreement to sell 100% of its ITP Aero division for 1.7 billion euros to Bain Capital. That's equivalent to 1.4 billion pounds or 1.9 billion US dollars. I know the company has been trying to sell this division for a while. It's going to really help improve their balance sheet. Year after year, the company is always one of the top aircraft manufacturers in the world. In 1884, Henry Royce started an engineering business. In 1906, Charles Rolls and Henry Royce created a separate business to sell cars. In the 1970s, the company filed bankruptcy and stopped making cars. BMW subsequently acquired the name and currently makes Rolls-Royce cars. The last dividend they paid was in April 2020 and suspended future dividends due to weak sales from COVID. The company is headquartered in London, England, and was founded in 1904. The ticker can be found on the OTC, Mexican Bolsa, Deutsche Börse, and London Stock Exchange. If you live in the US and wanted to invest in them, the ticker is RYCEY, R-Y-C-E-Y. Let's get started with the model. We're going to look at the ticker that trades on the London Stock Exchange. So all the numbers in this video are in British pounds. 7.7 billion market cap. They're trading at 92 pence, which is a little under £1, and they have 8.4 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They were generating positive free cash flow in 2018 and 19, but then in 2020, due to less air travel, they had negative 4 billion pounds of free cash flow. It did improve in 2021 at negative 800 million pounds. Net income is the profit or loss on the income statement. It's revenue minus expenses. And they had big negatives every year, although in 2021 it was positive 121 million pounds. Revenue is a sales for the company, and that peaked in 2019 at close to 17 billion. Then it dropped to about 12 billion, and it's come down a little bit from then to 11.2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. All the expenses related to building and servicing the engines are part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. Their gross profit was over 2 billion in 2021, and it was negative in 2020, and they had less revenue in 2021. Below that is their operating expenses. Research and development is a big operating expense for this company. Below that is their operating income. And you could see how efficient the company's becoming. With their lowest revenue, they have positive operating income. They spent 250 million pounds of interest on their debt, which is higher than prior years. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income. And they did manage to squeak out a small positive net income in 2021 with lower revenue. This is the company's income statement from their annual report. And this shows us 2020 and 2021. Their revenue is 11.2 billion pounds. Even though they're a London-based company, they generate the most revenue in the US at 3.5 billion. UK is second at 1.5 billion. Then China is third at 1.2 billion. But you can see how important this company is. They sell products all over the world. Their cost of revenue was 9.1 billion, so their gross profit is 2.1 billion. Their gross margins are 19%. That's gross profit over revenue, which is worse than their industry average of 27%. But it's a lot better than last year, which was negative. Their admin costs are 900 million, R&D 800 million. They cut their R&D a lot. Last year was 1.2 billion. So they have positive operating profit. Last year was negative. And they are spending more interest on their debt than last year. They received a tax credit of 418 million pounds. That's why they have positive net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. In 2020, they lost 3 billion of cash flow. In 2021, it was a lot better, only 259 million. And they're a manufacturing company, so they spend a lot on CapEx. When the company buys a warehouse or machinery to make its products, that's all part of CapEx. And that dollar amount is put onto the balance sheet and depreciated over its useful life. Operating cash flow minus CapEx gives you your free cash flow. And they were doing okay before 2020. They had over 900 million of free cash flow in 2019, but it was negative in 2020 and 2021. To get through COVID without going bankrupt, they had to add a lot of debt. They added 2 billion pounds in 2020 and 1 billion pounds in 2021. They also added 2 billion of stock in 2020. This is their operating cash flow section from their statement of cash flows. And the way you calculate operating cash flow, you start with your operating loss or operating gain. Then you add or subtract the non-cash items on the income statement, then adjust for changes of working capital. In 2021, they had an operating profit of 470 million, but lost 259 million of cash flow. The main reason was all these negatives in working capital. They had a cash outflow of 400 million in provisions. Provisions is when you put cash aside for future potential losses. They had a cash outflow of 169 million on inventory. Last year was a cash inflow of 600 million. They had a cash outflow of 500 million on receivables and payables, and a bunch of other items. I like to track a company's revenue. This is their revenue since 2015 and operating cash flow. And they did have positive operating cash flow for many years. Then in 2020 and 2021, it was negative, but it's coming back. I have a feeling it's going to be positive in 2022. Even though their revenue dropped a lot in 2020 and 2021, the forecast is for their revenue to grow slightly, but their operating cash flow to become positive and fairly healthy. This is their investing and financing sections from the statement of cash flows. In their investing section, they purchased 231 million of intangibles. You cannot purchase intangibles. You get them as a result of acquiring a company. They spent 328 million in PP&E. They disposed of a business and received 100 million. In their investing section, they had a cash outflow of over 400 million. Last year was over 1 billion. In their financing section, they paid down 1 billion on a loan. They added 2 billion of debt, and a bunch of other smaller items. In their financing section, they had a cash outflow of 88 million. Last year was a cash inflow of 3 billion because they added nearly 5 billion of debt. This is the equity section on their 12/31 balance sheet. They have negative 4.7 billion of equity. They raised 2.7 billion from selling common stock, and they lost 8.5 billion from running their business. Accumulated losses is a sum of all their prior net incomes minus the sum of the dividends they paid out. Let's look at the capital structure. They have negative equity and almost 8 billion of debt, so they're 100% debt. They did have positive equity in 2015, that's the blue line. And then in the middle of 2018, it turned negative. The low point was in mid-2020, but it improved a little bit in 2021. This red line is their debt balance, which keeps rising. And the green line is their cash balance. I gave them a WACC of 8.14%, and that's the average of the WACC on Simply Wall Street and the lowest WACC on Finbox, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 13 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of 11 billion pounds. We divide that by 8.4 billion shares. and we get a calculated stock price of 127 pence. They're trading at 92 pence, so they're trading at a 27% discount. It's a buy according to the model. Their revenue is projected to grow 6.8%, so I grew it by that amount for the next 4 years. That's how I got their future revenue estimates. In 2018 and 2019, they converted 5% of their revenue into free cash flow. So I multiplied their future revenue estimates by 5%. That's how I got their future free cash flows. I assumed they would have negative free cash flow in 2022. So in 2023 through 2025, I multiplied their revenue by 5%. The website Simply Wall Street values the company at 82 pence. They're saying it's 14% overvalued. This is where the stock has been trading the last 5 years. At one point it was close to £4, but you can see it came down a lot during the COVID crash. And then a few months later it hit its lowest point. It was below 50 pence. But it has come up since then. But the past couple of months, it's down about 30 or 40%. In the past 5 years, the S&P 500 is up 90%, while this stock is down 64%. And they were tracking each other for the first 2 years. Then this stock just fell off a cliff. They were paying a decent dividend prior to 2020. At one point, it was over 3%. The forecast is for the company to bring back their dividend in 2023, which I think is definitely possible. They have a pretty high beta, 1.81, so the stock is volatile. It moves almost 2 times the market. It's gone down 17% in the past 52 weeks, while the S&P is up 13%. The 52-week low is 83 pence. The high is 161. And the stock is trading below its 50-day and 200-day moving average. This is a really popular stock. Over 50 million shares are traded each day. Of the 8.4 billion shares outstanding, 8.2 billion are on float and 63% are held by institutions. Their employee count peaked in 2019 at 55,000. It's come down a little bit since then. It's currently 44,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be really unhappy at $1,100 today. That's an 89% loss. In the past 12 months, there's been a lot of insider buying, but no insider selling, so that's a good sign. 75% of the company is held by institutions, 23% by the general public, 1.4% from private companies, and 1% from employee schemes. Their top 5 biggest shareholders are all American companies: Causeway, BlackRock, Capital Research, Massachusetts Financial Services, and Vanguard. Let's look at their financial ratios. They don't have a good PE since their net income is so small. They do have a really good price to sales ratio, that's stock price over sales per share. It's below 1, so that means their revenue is higher than their market cap. And we can't look at their price to book ratio since they have negative equity. Let's look at their non-current assets: $4 billion of intangibles, $4 billion of PP&E, $1.2 billion of right-of-use assets. These are assets they lease from other companies. $400 million from investments in joint ventures. $2.2 billion of deferred tax assets, so that should help decrease their taxes in the future. And $1.1 billion of retirement benefits for its employees. Let's look at their non-current liabilities. $7.5 billion of debt, $1.6 billion of payables. This is how much money they owe others. $6.7 billion of contract liabilities, $1.1 billion of provisions, and $1.4 billion of employee schemes. They can cover their current liabilities with their current assets. Their current ratio is 1.3, and their quick ratio is slightly below 1. Let's look at their current assets: $4 billion of inventory, $5.4 billion of receivables. This is how much money is owed to them. $1.5 billion of contract assets. An example of a contract asset: say a company wants 10 aircraft engines, so they sign a contract for 10 aircraft engines over 12 months. And every time Rolls-Royce sends that company an engine, they post that on their balance sheet as a contract asset and liability. Once they send all 10 engines to the customer, then they can remove that from their balance sheet and put it onto the income statement. Let's look at their current liabilities. $6 billion of payables, this is how much money they owe others. $3.6 billion of contract liabilities, and $475 million of provisions. They lost over $800 million of free cash flow in 2021, but they have nearly $3.5 billion of working capital. So it looks like they do have enough funding to get through the next 12 months without needing to add any debt or equity. Say for example, $2 billion of debt matures in the next few months. They'll probably add $2 billion of debt to pay down that debt. The best way to look at ratios to compare them to companies in the same industry. There are 64 companies in the same industry as Rolls-Royce, and Rolls is 10th largest in terms of market cap at $7.7 billion. I converted all these numbers to pounds, and a lot of these companies pay a dividend. Rolls does not. It was paying a dividend up until 2020. Their earnings are really low, so they have a pretty weak price to earnings ratio. But they have the best price to sales of any of these companies. So that should give you a little more confidence in the company. Their 3-year annual growth rate is 5%. The average is 14%. Look at L3 Harris, 40%. Wow. So to summarize, I have them trading at a 27% discount. And this is one of those companies that is too big to fail. It's too important in the British economy. It's been around well over 100 years. It supplies lots of jobs. And if they do go bankrupt like they did in the 70s, the British government will bail them out. It's trading at a really low point, 7.7 billion market cap. It has huge potential. If it could just lower its debt and start to become profitable consistently, the stock should do really well. I ranked their free cash flows 3 out of 10, their revenue 4 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.